could think that a Forex trader can't teach us option traders anything new, but that's where you're wrong. After recently spending a couple hours with him, I feel he is the most passionate and successful trader I think I've ever met. He's going to teach you a very effective yet extremely simple multi-time frame trading strategy, and hopefully he'll be showing some real-time live trading setups. As the market will be open tonight, time permitting, Joseph may even execute some of these live trades. So he's going to be speaking about the simplest way to beat any financial market and what brokers, market makers, and the most successful traders don't want you to know. So without further ado, please welcome Joseph Nemeth.
Thank you. I have an accent, which means that by the end of the presentation, some of you might love me and some of you might hate me. Usually I do better with the ladies. Men kind of, sometimes okay, sometimes not so. Also, I tell it like it is. In other words, I'm going to tell you everything, not everything I know, but I am going to tell you the truth about the financial markets, and the chances are that a few of you might be upset. And the reason why you might be upset because I tell the truth. A lot of you will love me for it because I tell the truth. Now, those of you that will be upset is because the chances are you are a trader, and like most traders, you are probably married to your trading strategy. And you have been trying very, very hard, and we as traders, we're kind of a funny bunch, because not only we are married to this strategy, but even if it doesn't work, we try to prove it right. And we sit and wait and try to prove that whatever it is we're doing is correct, even if it's not. Now, by the show of hands, let's just see how many of you are equities traders? All right, good. How many are futures traders, futures contracts? Just a handful. Foreign currencies. All right, options? Wow, a lot of options traders. Commodities. Nobody? How many have been trading for less than a year? How many less than 5 years? More than a year? This is just to give me an idea of who I'm dealing with. How many close to 10 years? More than 10 years? Good. How many are really happy with the results you've been getting? How many would like to improve upon their results? All right. Okay, good. All right. Before we go any further, we have to do this. You know, it's the law.
Trading stocks, options, off-exchange foreign currencies, as well as futures contracts carries a high level of risk and is not suitable for all investors. The possibility exists that you could lose some or all of your investment capital, and therefore you should not invest money that you cannot afford to lose. No representation is being made that any account will or is likely to achieve profits similar to those discussed during this presentation. Also, past performance of any trading methodology is not necessarily indicative or a guarantee of future results. Any information presented is strictly for educational purposes and should not be construed as investment advice or an offer to buy or sell securities. You should be aware of all risks associated with trading and should seek advice from an independent, competent, licensed financial advisor if you have any doubts. The views and opinions presented here do not represent the opinions of Rio Salado Community College.
Anybody does not understand that? All right, so we can go further. By the way, what is the difference between a licensed financial advisor and a slinky? Well, I kind of look at it this way. They are both pretty useless. But they both put a smile on your face when you see them tumbling down the stairs. Kind of. Yeah, actually an ex-uncle of mine a retired, prominent heart surgeon, age 70, has been working again for the last 5 years. Multi-millionaire at one time had to come back from retirement because a prominent financial advisor managed to successfully not swindle him, lose a lot of money for him, to the point where at 70, a multimillionaire is back at work. So that's what financial advisors do. Now, if they are licensed, what it means to be licensed, that you are legally doing what is otherwise illegal. Right? So he can legally lose other people's money. If he weren't licensed, he'd probably go to jail. But if he's licensed, he can legally do it. All right? So, let's start. If there was one word you could use to describe the world we live in today, what would the word be? You know, I've done presentations similar to this one all over the world. And when I ask this question, almost always, or 90% of the time, I get the same answer. Chaos, chaotic, screwed up. Why do you suppose people have the same answer anywhere? Almost always the same answer. Why chaos? Do you think that might be it? Most people today have no financial security. Now, without financial security, there is no certainty that we have in our future. True or false?
No freedom.
True? Financial security is the basis of our very survival, isn't it? Right? So, we have a problem as a society, as people. What is the problem? One of the biggest problems is that most people, not all, most people, have difficult times living comfortably, let alone saving enough money for retirement. True? True. And for most people actually, having a job, just a job, isn't enough. So they look for alternatives. And one of the alternatives is financial markets, right? Investing in stocks, options, forex, futures, commodities, ETFs. Thousands, if not millions of people get lured and get excited over the vision of seemingly easy money. Huge returns. Right? And those returns are there, provided you know what you are doing. But unlike almost any other profession, we so haphazardly get involved in this business without really knowing what we're doing. Without proper education, proper skill. Why is that? Because trading seems so easy and simple. There's only two things that can happen. The market goes either up or down, nothing else. Simple, right? I thought it was simple, and theoretically it is. So, unfortunately, most people who get in fail miserably because they are misinformed about the realities of today's financial industry. Misinformed. So what my goal is going to be today is to help you understand some of the truth in today's financial markets. Won't be able to do it all, but at least some of it. Now, When I look at a group like this, I cannot help but think that many of you must be insane.
Many or all?
If not all. Insane, certifiably.
You know who you are, raise your hand.
Or just dangerously brave. One or the other. Or just extremely naive. One of the three. I don't know which one. I know I was naive. When I first got in, I was naive. Well, why? Well, let's think about this. In spite of whatever you've been told, whatever course or training you paid for, every transaction, every financial transaction has two parties involved. Whether you buy or sell, on the other side of that transaction, there has to be someone, correct? And when the transaction is done, at the end, when you close the deal, there will be no ifs, ands, or buts about it. There will be a loser, and there will be a winner. Every single financial transaction in the world has a loser and has a winner. It doesn't work any other way. So why do I say that you're insane? Because here you are. What makes you think that you will be able to take money from the most successful, most corrupt, and the richest Wall Street fat cats that control this whole thing? Do you really believe that they'll let you take their money? Here you are hoping that you will. But think about it. This is the cruel reality of what happens out there. Now, we have to go back and find out what you know about the industry, what you know about trading. Where is your education from? Your training? How did you acquire it? Where did it come from? Where is its origin? Who taught you? Who prepared you for this? Think about it. Was it Warren Buffett? Stephen Cohen? Did you go take some courses with Goldman Sachs? How did you come about this education that you're applying, and for the most part not so successfully, because if you were successful, the chances are you wouldn't be here? True? Right? Where did it come from? Now, is it possible that if you've been getting the wrong results, you may have to accept the fact that much of the information you've received has been false or misleading? Can we at least accept that possibility? Right? So, now, to prove my point, you can go to any bookstore and pick up this little book by one of the most successful investors of all time, George Soros. And the reason why I pick him is because he's very good trading foreign currencies. And I love foreign currencies. But we don't have to dispute the fact that he really knows what he's talking about. Well, here's what he says in his book. One cannot escape the conclusion that both the financial authorities and market participants harbor fundamental misconceptions about the way financial markets function. Think about it. These misconceptions have manifested themselves not only in a failure to understand what is going on, they have given rise to the excesses which are the root of the current market turmoil. He goes on and says, I shall argue that global financial system has been built on false premises. Emphasis added. This would be a shocking proposition, except for even more shocking proposition that misconceptions characterize not only financial markets, but all human constructs. What does it mean? What does it mean? You don't have a clue. That's what it means. But read between the lines. What it means that every time we turn around, we are lied to because someone has a hidden agenda. You know, it blows my mind when I listen to CNBC and the market's going up and up and up and up. And those CNBC people are just so disappointed that the average retail trader, retail consumer, retail customer hasn't really been fully invested or is not fully in yet. When is the dumb money coming in? They're asking. That's what you are, dumb money. All right? So, and I learned this the hard way. You know, what I'm telling you is something that nobody told me. I had to find out the hard way. When I first started trading Forex, which was a little over 10 years ago, it wasn't the first time I started trading foreign currencies. I had traded before, probably another 10 years. But I did not consider that trading because I, like most of you and most amateur traders, market was going up, I was buying. So I wasn't really trading, I was buying. And then when the bottom fell out, I lost it all. So when I really started trading for the first time, I considered myself the worst trader in the world. In fact, I did a presentation for the Forex traders of Phoenix that was entitled, How the Worst Trader in the World Made $5 million in Forex. Why was I the worst trader? Well, looking back, in hindsight, I know where I was making the mistakes. But one of the basic things I did not understand, and that was the fact that someone has a vested interest in my losing money. Someone has a vested interest in you losing money. Remember that transaction? You either win or you lose. That's the way it is. Now, I'll go over a few scenarios. And the question is, has this ever happened to you? Have you experienced any of this? As a trader, you're trading. Now, you got stopped out with a loss, of course, only 2 ticks before the market reversed. Could be 5-3, could be 1, could be right on the tick. Has that ever happened to anyone? Right? Used to happen to me all the time. And it didn't matter on what side of the market I was. If I buy, I get stopped out on on the short side. If I sell, I get stopped out on the high side. Didn't matter. I would reverse my position. Oh, the market's going in that direction. Guess what? I get stopped out again. Has that ever happened to you? You go long, you get stopped out short, then you say, okay, I guess the market is reversing. You go short, you get stopped out long. How about the market reverse 2 ticks before reaching your limit? Right? Has that ever happened to you? All the time. Right? How about you close the trade because there was nothing going on, or you were up and down and up, and finally you closed the trade, you couldn't take it anymore, only to see the market run another 100 points immediately after you closed the trade. Right? How about market reverse the very minute you entered the trade? Right? You get in and the market goes the other direction. I mean, it's like, it's guaranteed almost that will happen, right? How about this? Entered the wrong trade by mistake and made money, finally. Right? How about this one? Closed a losing, this is my favorite, closed a losing trade only to find out that you'd be in profit just a short while later. Right? Watched many profitable trades, many trades in profit evaporate into a loss. Right? How many times? If you could only have the money that you had in winning trades that ended up losers. Now, got a solid trading signal, but procrastinated and hesitated and didn't quite know whether this was it until you completely missed it and the market ran away. And then probably you ended up chasing it. You got in at the very end of the move and the market turned. Right? Now, and this is how I felt. If you at the time were watching or looking over my shoulder and watching what I was doing, every time I place a trade, you'd make money 100% of the time only if you'd go the other direction. Right? Why does this happen? It seems like the whole world is watching you only to screw you. It seems like nobody else is trading, just you against the world. Right? Well, I finally came to realize that, number one, I wasn't alone. Number two, there was a reason for all of this. And everything I knew about trading, I had to forget, start from scratch, and I became successful only after I realized that whatever I knew I learned, the traditional way of trading, was either false, misleading, or just a downright lie. And I venture to guess that the same thing is probably going on with you. So it'll be an easy fix. That's the good news. All right? So this whole thing, I mean, I don't think I have enough time, but I could go into just a detailed explanation how this thing happened. But bottom line, because of an accidental trade, my luck, if you will, changed, and I started trading in a way that is contrary or contradictory to the traditional trading wisdom, to the traditional teaching. Because when we think about it, where did our teaching come from? We as amateurs, where did we learn to trade? Who taught us? The pros. Really. I'll tell you, I'll submit this to you. The most successful traders don't give their secrets away. You don't have Stephen Cohen going around and teaching people how to trade. You don't have Warren Buffett or George Soros going around teaching, giving their secrets away, teaching you how they do it. People from Goldman Sachs, they don't do it. People that teach usually charge you to teach you, when ironically they themselves probably don't have a clue. They are only regurgitating something that they read somewhere. That's it. And I don't want to offend anyone, but it is the truth. And you need to accept it, or else you will continue doing the same thing you've been doing, and guess what? You will not be getting different results. Same results. So, I discovered the three biggest, what changed my life really as a trader was discovering the three biggest lies in trading. Would you like to know what they are? I thought you might. Okay, what's the first lie? Let me help you. What is probably the most profound statement you hear every time you attend a trading course or some type of trading education? What is the one thing that they keep repeating over and over and over and over? Well, trend is your friend. That's not a lie. That one is not. Here it is. Never, ever, 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 ever trade without a stop loss. You show me a person who trades with a stop loss, I will show you a loser every single time. I don't know a single successful trader who trades with a stop loss, period. Ever. I've never met one, and I never will. Because markets are volatile. They're noisy. They go up and down, even inside a trend. And what else do they tell you besides never ever trade without a stop loss? What's even better than a stop loss? It is a tight stop loss, isn't it? It's funny, isn't it? When you think about it. Well, imagine this. Think about this. Someone is on the other side of that transaction. Someone put this information out. Now, here's the deal. They could take all of your money in one fell swoop. But you know, they're not going to do that because you might just get pissed off. And if you're pissed off enough, you might go sue them and cause all kinds of noise. So they'll take it one little tiny stop loss after another stop loss. One stop loss at a time. That's it. And, well, you're just not a very good trader now, are you? You're just terrible with picking out the direction of the market. You get stopped out all the time. Do you think that when Warren Buffett takes a $5 billion position in Bank of America, he's thinking, oh boy, we'd better put a real tight stop loss to this trade? Do you really think so? Do you really think that when Goldman Sachs takes a $5 billion position in oil, or whatever it might be, that they're thinking, well, we'd better find where we're going to put the stop loss, maybe right down here below this last low, you really think that's the way they trade? You are more insane than I thought you were if you think that. They don't use stop losses. No big traders, successful traders, use stop losses because it is more risky than the trade itself. You might as well hand over your money. They will come and grab your stop losses. It's a scheme to take your money, ladies and gentlemen. No more truth to that than the man on the moon in 1969. That's the way it works. But it sounds so good, right? It sounds so good. Well, you got to put a stop. You don't want to lose your entire account. Put a stop loss. You put a stop loss, you lose it. One stop loss at a time. Second lie. The market is always right. Here's another lie to convince you that you are an idiot and you don't know how to trade, because the market is always right, you are wrong. Makes sense, doesn't it? But the market is never right. In history of the market has never been right, ever, ever. If it were right, it'd be like buying oranges at Fry's. There'd be a given price. You buy gold for $1,400, whatever the price happens to be. And that price is there. The market is right. But how is it that in the morning is gold is $1,400, in the afternoon it's $1,500, the next day is back to $1,300? Well, when is it right? Which one is it? The chances are you got stopped out a few times in there, so it's all good. The market is never right. There's just a bunch of speculators hoping to find a better price than the trade when they first got in. That's it. And you'd better hope that the market is never right, because then there is no money to be made. If the market was right, it wouldn't move, would it? Market is constantly, blindly looking for some price. That's it. Never right. And when you think it found the price, it's the wrong price again, because it will move in the next minute or so. Right? Next slide. The history repeats itself. What a crock of history repeats itself. Like which history exactly? And how is it supposed to be repeating itself? Like because last month the market went up, is that what's supposed to be happening? Or because in 1959, in February, the market went? What exactly do you mean? And don't also get caught up in this bullshit with the different figures in the market. Like the double tops and the pen and handle and the head and shoulders. What kind of crock of bullshit is this? Seriously though, it has nothing to do with the price of tea in China. Nothing, absolutely nothing. People are trying to beat the market. And everybody thinks they found the Holy Grail. And they invent things because it just happened to work out coincidentally a few times. How do you know a head and shoulders formed? How do you know it? You know it with the benefit of hindsight. You know it when it has formed. Not before, after. How do you know a double top form? How do you know a resistance held? Well, sometimes it holds, sometimes it doesn't. How does the history repeat itself? You might as well be tossing a coin. It's bullshit. Don't believe in any of that, because that only goes to prove that you're a bad trader. Sometimes it paints out, other times it doesn't. And you only know after the fact. How does it help you after the fact? It's like closing the door on a barn after the horse is already ran away. You're guessing at that point. You're guessing. Never guess. I'll teach you a way 75 to 80% of the time you will know exactly what the market will do tomorrow. Would you like to know that?
Yes.
Without guessing. No guessing. Just pure mathematical statistics. Nothing more than that. Simple. Right? So, after I eliminated stop losses, I started making money. Not until then. Since I was becoming more and more successful, developed a way to turn any and every any trade into a winning trade. It doesn't matter how bad or good my entry was, but at the end of the day, or week, or whatever, at the end of the transaction, the trade was profitable. I refused to give money up anymore. I only use 3 simple indicators. None of this Ichimoku and Elliott waves and bullshit Fibonacci. None of that. Because it's horse. It has no meaning whatsoever. You know what matters? There is only one thing that matters. At the end of the day, what is the one thing that matters? Price. That's the only thing that matters. Nothing else. So, the only thing I use is exponential moving average to identify the trend. You know why? Because I'm not very good with charts. But when I look at a line, I can tell whether it's going up or going down. And generally speaking, when the market's going up, the EMA or moving average is going up with it. When it's going down, it's going down. You never have a market that is going down, yet its exponential moving or simple moving average is going the opposite direction. Doesn't happen like that. Mathematically, it cannot. Impossible. All I do is use moving average because I want to know which way the market's going. Remember, only one thing happens. One thing matters. Price. Is the market going up or is it going down? Nothing else matters. No bullshit head and shoulders or flags or whatever. Crazy. Price matters. CNBC doesn't matter. Remember, when you watch CNBC, there is someone who's talking who has an agenda. There's a reason why they're saying what they're saying. They are probably in some trades and they don't want to be on the losing end. Every time you make a trade, keep that in mind. Someone is on the other side and they don't want you to win. That's what you keep in mind. Nothing else. No pennants. No pylons. Cup and handle. Crazy. All right, and I use MACD because it's a combination of moving averages. I like that. And I use CCI because that's a good indicator. And that's it. I don't use anything else. Nothing else. Nothing else. Then I learned how to identify a trend. I'll show you how to do that. And remember, only price matters. Forget news. Logic doesn't apply. How does this make any sense? Apple, APL. Last quarter made more money than Amazon. Amazon in its entire history. In one quarter, Apple made more money than Amazon in its entire history. Why is it that the P of Apple is like 7 or 8 right now, and Amazon is like 3,000? How does that logically make any sense? Right? So logic doesn't matter. Fundamentals, you think fundamentals really matter? Fundamentals, well, we're going to print money, and so the currency will go down. I mean, those are fundamentals. I mean, you can take that to the bank, but other than that, I can't think of anything else. So it doesn't matter. You know why it doesn't matter? Because the computers and the computer algorithms have taken over trading. Logic, no, doesn't matter. Trend, yeah, there's still the mass euphoria when something goes up. People still want to get in for a while, right? All right, and one thing you got to do when you don't use stop losses, you have to eliminate emotions. And I'll show you how to do that as well. So let me show you how to make trading simple and fun. Now, why do I do this? I got better things to do, right? But sometimes I get bored. But yeah, I have an agenda also. I'm not doing this for nothing. Remember that. You can get anything in life you want if you only help enough people get what they want. I want something. And I believe that if I help you get closer to your trading goals, somehow, perhaps, by the good karmic effect, because I do believe in karma, I'll get closer to what it is I want. Fair enough? All right. Now, if you don't remember anything from this presentation tonight, remember this one thing that I'm about to show you. And, well, it starts with a question. Would your trading improve if you could predict tomorrow's market direction with a 75 to 80% accuracy? 4 out of 5 times, you'd be right. You will be wrong. 1 out of 4, 1 out of 5. But all the other times, you'll be right. If you don't know anything more than that, I think you'll be a better trader. Because I don't really know. Maybe you do know this little trick. But it's very, 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 very simple. And I'll teach you how that works. Basically, it's not guessing. I don't like guessing. I don't like gambling. Anytime there is a game of chance where the odds are stacked up against me, I'm just not in. You know, I'll go to Vegas. I'll go to the shows. I'll do a little drinking. I'll play a little poker. But I won't play any casino games where the odds are stacked against me, because with my mathematical background, I just can't force myself. I can't do it. I can't go and sit at a table and play blackjack. You'll never see me ever doing that. I just can't do it. 2% odds against me, no. I work off of statistics. Now, I will need a volunteer for this exercise. Stand up. What's your name, sir?
David.
David. Give David a hand. Yeah, you'll be standing over here, and the chances are you'll need to mark some results. Volunteer number 1. I will need one more volunteer to verify what I'm doing. Not everybody. Mornay, come on up. All right, we're going to use a coin to demonstrate just pure basic statistics. Now, a coin, would you say, ma'am, that this coin is not fake? It has 2 different sides. This is the head.
It does.
That's the tails. Heads, tails. Now, what do you think are my chances of correctly predicting the outcome of the next toss? 50%. How did you figure that out? I mean, how would you know that? Well, let's do an exercise, all right? So, Mornay, you're going to be calling the toss. I will be flipping it. This lady over here will verify that what lands, and this gentleman over here will be marking, and what you will be marking is either T for true or F for false. So we're going to have T's over here and falses over here. All right? So, Mornay, first toss.
Heads.
Tails. False. You're 2 ahead. There's false. There. F. He didn't guess. Next one.
Heads.
Heads. True. T.
50-50.
Next.
Tail.
Heads. False.
Head.
Tails. False.
Tail.
Heads. False. You're not very good at this game. All right. My point is simply this. If I end up, or Mornay keeps making these guesses, and we do 100 of them, how many T's and how many F's do you think he'll have, give or take? About close to it. The more tosses we do, the closer we're going to get to the 50-50, right? If we do 1,000, we might be like 49.99, but for the most part, 50-50. I don't like those odds, but those are pure statistical odds. I'm going to show you how to do the very same thing in any market. Pretty much you name it. It doesn't matter what it is. Because the advantage that we have is that markets have a tendency to trend. Right? They don't go up and down, up and down, up and down. Sometimes they do. But long term, they have a tendency to trend. So what we need to do is find a statistical edge that will help us better our odds. All right? So what we're looking here is a Heikin-Ashi chart of S&P 500. S&P 500 is the mother of all markets, correct? Everything pretty much revolves around S&P 500. Now this is approximately a year, from 215 to 212, 215.12 to 212.13. So that's today. All right, I mean, I don't think the market was completely closed, but we know that it ended up high. Now, what do you notice? I mean, the first thing that you notice over there. Anything? First of all,
The reds are grouped together. So are the greens.
that's very, very good observation.
It's a Heikin-Ashi chart.
It's a Heikin-Ashi chart. Now, anybody not familiar with Heikin-Ashi? I'll explain it to you later, or maybe, but basically it is, I don't use any other charts. I don't use bar charts. I don't use candlestick charts. I don't use any of that bullshit because there's a lot of noise. I don't like noise. It confuses me. It's like moving the goalposts. Imagine that. I don't like it. Okay, I like to find a better way to paint or illustrate the market, to show the market than your typical standard chart. So all I use Heikin Ashi. I use something else too, but Heikin Ashi is my favorite. Now, let's just move in a little bit. Let's just take the last few months over here. So let's go forward. So we'll take 1, 2, 3, last 4 months. And here's how I'm going to play this. Like I was guessing on the coin toss, we just make a guess because we'd have nothing to go on. We just make a guess. But over here, my guess or prediction is going to always be the direction of yesterday, right? Yesterday's direction will be, or today's direction will be my prediction for tomorrow. Let's see how well I do. I'm going to be calling true or false, or I'm gonna say right or wrong. So you're gonna do R and W. Fair enough? So let's start. This is our first day. Let's start at the beginning here. All right? And this is our starting point. So here we go next day. And I'm always going to predict the market based on the color of the previous Heikin Ashi candle. Right? So here we go. First one is down. So I'm always going to go in the direction of the previous one. So I'm right. I'm right. 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 Wrong. Right. 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 Wrong. Right. 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 Wrong. Right. Right. Wrong. 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 Right. 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 Wrong. Right. 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 So, fast forward. So if we do this to the mother of all markets, or any market for that, if you do a Heikin Ashi analysis of the daily chart, where your prediction is always the previous day's move, prediction for the next day, you'll come up with these results. This is 1 year at a time. I have personally done this, so you can take this to the bank. So from November 30th, 09 to November 30th, 10, 254 trading days, of which 192, you would be what? 192 times right, 62 times wrong. That's a 75.6% accuracy. Next year, from 11/30/10 to 11/30/11, 253 trading days. We lost one. Was this a leap year? I don't know. 202 right, 51 wrong. 79, almost 80% accuracy. That's pretty good, right? You can do this to euro dollar, anything. Next, 11/30/11 to 11/30/12, 253. This must have been a leap year. 253 trading days, 203 right, 50 wrong. Look how close this is. I mean, you can't make this stuff up. Right? Thank you. Right? 80% accuracy. You average it out, that's 75 to 80%. I can tell you with 75 to 80% accuracy which way the market is going to go tomorrow. And with that set of mind, I'll be trading.
What if there's some terrible news like Obama speaking tonight.
That,
Market is supposed to go up tomorrow.
yeah, that will be one of those days that you're wrong. It's all right. It's part of... it'll be one of those wrong ones. Oh, all right. It's part of the statistics. It'll be one of those days. You won't make a whole lot of money. But this doesn't necessarily mean that if I think the market is going to go up or down, that I'm going to trade in that direction blindly. No. This is just my starting point. See, to start trading, I'm already 75% ahead of most people that don't have a clue, that will be guessing. Again, I couldn't use bigger letters, but I'm saying I only use Heiken Ashi charts because they are a lot smoother than your regular charts. Now, this is a 5-minute chart of euro dollar. Right? What am I supposed to do with that? Now, trading today is not what it used to be 10 years ago. Markets used to trend a lot better. The noise wasn't as great as it is now. The noise wasn't as volatile, as didn't have as much a range as it does today. The retracement from the trend weren't as big as they are today. Why? Because for the most part, the computer trading algorithms have taken over. There's not a whole lot of manual trading going on anymore, or at least not with the big investment houses. It's all computer algorithms, man. That's it. And they just go one direction and the other. Now, remember this. When Goldman Sachs makes a bad trade, I want to illustrate something to you. It's a bad trade. What do you think they do with it? They get rid of it, close it because they're down? It's like inventory. It's as if I were selling onions. You know, I buy a bunch from a wholesaler, and now they're sitting in my warehouse until they're ready to be sold for profit. Their balance sheet, which is an advantage that you do not have, can handle a whole lot of losing trades, man. A lot, billions and billions and billions, and they don't have to report on it. It's on their balance sheet at the price that it was acquired at. If the trade is completely crap, they might 2 years later or 3 years later have this write-off, and you hear about it. Well, they took a $2 billion write-off. I wonder why. They're not going to get a margin call like you will. That's why be smart. You are competing not on an even playing field. It's not an even playing field. The people that want to take your money have a whole lot more than you do. Keep that in mind. All right? So that's why that happens. So I want to smooth this out so that I can kind of better gauge the market. So when I illustrate this with a Heiken Ashi chart, it looks like this. Right? Eyes wide open. Big difference. See, I can see the moves. I can see where I can get in. And here's my predictor. You know, because what I do with the daily works just as good on a weekly 240, 120, not so much on the 5-minute ones and so on. But on the longer term ones, 30 minutes, 60 minutes, from 30 minute up. Right? So now this is the 5-minute USD smoothed out with Heiken Ashi. Now, let's compare them side by side. Big difference. Candlesticks. How about this one? This is 120 euro yen I love euro yen. 250, 200, 250 pip moves overnight just like that. Just perfect. Can't be anything better. Well, this is just a regular candlestick. Now, see the difference? See the difference? Hello? All right. So, now, are you ready now to take some money from the fat cats on Wall Street? They are probably eating at a $30,000 per play charity function tonight while we're learning how to trade. And they call your money dumb money. Even on CNBC, blatantly, dumb money. Where's the dumb money coming in? It's about time. What are they? Can't they see? It's about time to suck everybody in so that we can turn it. Just like we always do. And don't think it's not going to happen. Wait. All right. 3-step trading strategy, so simple that you'll be saying, why didn't I think of it? Right? 3 steps, that's it. Very simple. Step 1, determine what I call the master direction. You know what the master direction is? I already showed you. That's the master direction. When I start trading with that in mind. There's a 75 to 80% chance that the market will be going in this direction. That's my starting point, right? So let's go back to the daily chart. This is very recent. Euro dollar, everybody should know that. If I look at the very last bar, it's green. So I would have been wrong today, but it's okay. I might be wrong tomorrow, but guess what? I'll catch these and that. Right? So, but that's just the starting point. Now, even if the market goes against me, if I'm wrong, doesn't necessarily mean I will be in a bad trade. I may just not get in if the other 3 steps don't fall in. Right? Alrighty, so now what do we see? Green bar. We're going to assume the market's going to go up, provided that we get the right setup, which will come from step 2 and step 3. Now, similarly, we can look at a 240. Look at that. Up. Based on my last, market's going up. So this is on a smaller time frame. Next, we will determine the trend. Now, remember, that was the master direction. I have my own terminology. Invented it along the way. A lot of words or a lot of expressions you never heard before, but we'll try to get through it. All right, step number 2. We're almost halfway there. Determine the trend. And the trend we determine very simply on a 60 or 30 minute, or depending, if you are a very, very long-term trader, you might need to use 120-minute chart to determine the trend. But it doesn't matter which chart you use. There's only 3 things you need to consider when determining the trend. It's the slope of the 20-period exponential moving average. You can use simple if you have a problem with exponential. It's not really all that important. It's the last Heikin-Ashi bar, which both must match the master direction. So if our master direction, our predictor was up, then we're looking for a trend that goes up. So in other words, Heikin-Ashi is green, and the slope of the 20-period EMA is pointing up. And the price, I don't always necessarily pay attention to this, but you, as the beginners of the strategy, I recommend that you do. The price relation to EMA, if the price is above the exponential moving average, we're going up. If it's below, we're going down. So here we go.
You're doing this just on Forex, right?
You can do this trading anything, not options. Why would you trade options in the first place? That's the worst thing you can do. I mean, first of all, you've got a huge spread, extremely high cost of entry, extreme lack of volatility. You lose money even if you're right because you've got time decay. Why in the world? Who did you buy your training program from? Somebody charged you $3,000. I know it all sounds good. You limit your loss. You only lose what you put in. Well, if you put in your whole account, you lose it all. Well, in a market like, what do you sell puts?
I sell what? I might sell a call, I might sell put, but it always loses time value.
Well, of course it loses time.
That's why I sell it.
But if the market breaks away from you, you're holding that put or that call, and you're kind of up a shit stream without a paddle. And it's so tough to get out of a bad trade. You've got no liquidity. I don't care what options you're trading. I mean, you'll get into an option and 1/3 of the value will be your commission and spread. Why would you want to do that when you've got all these other instruments you can trade? If you're looking for the leverage, trade futures. You can get in and out just like that. Boom. Now, what if the market goes low against you? I mean, you're 50% of what you put in down before you even blink. Now, don't get me wrong. There is a place for options in the financial markets. If you want to, I mean, it's a derivative. If you want to protect a long position or a short position, I understand that. But don't think of all these butterflies and condors and all this bullshit. The more legs your option has, the more you're going to lose. Long term, always will. I'm sorry, this is an options group. I'm sorry, I shouldn't have said that. I take that back. I take that back. If you want to protect your equity position, yeah, by all means. If the volatility is down, you can buy cheap protection. But not if you're a trader, if you're an investor. But I'll tell you this, 10 years ago, if you had invested, I guess in this market, you would still be down as an investor, wouldn't you? Or pretty close to it. Yeah. So anyway, here we go. This is how we determine the trend. This is a 60-minute chart. We look at the very end. What's the slope of the moving average? Up. What is the last candle? Green or red? Green. That means up. Where's the price? Up, below, or above the moving average? All right. So slope, color, price. Up. Simple. Similarly, we can do that with a 30-minute, depending on how fast or slow of a trader you are. You see that? You see why it's up? Slope, color, price. So now we've established the trend. We have the master direction. They're all synchronized. Next step. That's our trigger. We need to get in. And what I used to use a short time frame, but I discovered it wasn't good. Now I only use a range chart or a Renko chart. Again, Renko and range charts are not time sensitive. Who is familiar with range charts? Renko charts. Not many. Well, this is your homework to study up on Renko charts and range charts. Basically, it is a Renko chart or a range chart. They're very similar. They will only paint a bar when the market moved the predetermined number of ticks or points in the market. If the market is flat, and let's just say that you're looking at a 10-tick Renko chart or 10-tick range chart, the chart will not paint a new bar until the market physically moved 10 ticks up or down, either direction. If the market is flat, it will not paint a new bar. It is not time sensitive. Now, why do I want a chart for my entry? Why do I want a chart that is not time sensitive? Because I don't care about time. All I care is about price, the movement of the market. That's what's important to me. Let's just say the market is not moving. A 5-minute chart or a 1-minute chart might be giving me green candles, red candles, green candles, and see, I'm very visual, and I don't need that. There's people that tell me that they trade off of a 1-minute chart, and I'm like, you gotta be kidding me. That's insanity. So I only wait for the move. If the market doesn't move, I'm not getting in, period. All right? So I'm going to look for an entry, and I base my entry on the color of the last Heikin-Ashi range or Renko bar. And step 2, I might want to confirm it with remember, the only other technical indicator that I will use, most likely MACD or CCI. So here's what we're looking at. This is a Euro USD 10-tick range chart. Each one of these bars is 10 ticks, 10 pips. Now, this might be an hour, might be 10 seconds. I don't know, and I don't care. All I want is the movement in the direction of my predictor, master direction, and my what? What was number 2? My trend. All 3 have to be synchronized. All 3 in one direction. So if I'm assuming that throughout this entire chart, we had the uptrend on both step number 1 and step number 2, right? So this would be my first entry. This would be another entry. See, I can confirm it with my indicator. Then I get into this one. My next one would be here. Next one here. So now basically these are my up. Here's an important thing. In my trading strategy, let's just say that normally you would get into a trade with 1 contract, if that's your normal trade. Don't do it anymore. Divide it by 5 and enter with 1/5 of the position size you would normally take. I'll explain to you why in just a little bit, why that is important. because that's part of trade management and also trade recovery. If you're trading a $100,000 account and trading euro dollar, and normally you would want to get in with one full lot or 10 mini lots, do it with two.
Mini lots.
2 mini lots. Right? Now, this is 5-tick Renko chart. Same thing, euro dollar, same kind of a time frame. This is slightly different, but also I cheat and I combine the Renko with Heikin Ashi. I kind of marry them together. And that paints kind of nicely like that. And here we've got 4 entries as well. Again, only open the trade with 1/5 of the position size that you would normally take. I'll explain to you why that's important in just a little bit. So, summary. You've got master direction. Is the coin toss? Not really, but same principle. Statistics of where we think the market's going to go. Then trend. Master direction, trend have to be in the same direction. Up or down. So here's the thing. When the market opens up and it's going down against my master direction, my strategy won't even allow me to get into a trade because they're not synchronized. They have to be going in the same direction. So this will prevent me from entering bad trades. Now, and my entry trigger is based off of a non-time sensitive chart. Range. You don't want to be entering off of a time chart because you'll get whipsawed. You know what that term means. You'll get in and then you'll realize, oops. And only start. Your first trade is only 1/5 of the position that you would normally take. Now, this is how I would have the setup. Here's my master direction. Here's my trend. Here's my entry with a confirmation indicator. You need to keep in mind is that the strategy can never change. You don't want to ever deviate from it. Every system has to be repeatable 100% of the time the same way over and over again, or else it's chaos. You have to have rules and always stick to them. And not every trade will work out. But if you stick to the rules, you'll know how to get out of the bad trades. All right. Is that pretty simple? Thank you. So, exit rules. Now you know how to get in. Only open your first trade in the direction of the master direction, the direction of the trend, on an entry where all 3 are synchronized in the same direction. Never speculate that it might turn, it might not turn. If you speculate the market will sooner or later go against you, it will cost you pain. All right, so how do we get out? Now we're in a trade, how do we get out? Take profit, or when in profit, take profit whenever range or Renko bar, which is your entry, changes color. Then re-enter only on new entry conditions, on the new setup. Remember what those bars do? They have a tendency to repeat themselves. So when a bar changes, why risk it that your profitable trade will go into a loss or you lose? You don't want to leave money on the table. Remember this. Nobody has ever gone broke taking profit.
That isn't true.
Well, because they don't know how to manage their losing trades. If I can teach you how not to have a losing trade, if you at least break even, worst case, break even on your losing trades, then every time you take profit, that's profit, isn't it? That's the way we work. All right, so let's look at it. Going back to the 5-tick Renko chart, we entered here, first bar, we're out. We're in profit, we're out. That's it. Wait for the next signal. Here, confirmation, here. Red bar, we're out. Next signal. Well, comes right after, right here. Whew, that's a good one. First bar, we're out. Something you need to understand with Heikin Ashi bars. Usually when the new bar paints, by the time the first bar is over, or previous bar is over, the new bar already starts painting in the direction that it wants to go. It's not, Heikin Ashi bars are not like candlesticks that they start from where the price ended. Heikin Ashis give you kind of a prediction of the next bar. So by the time this doji is finished, I would be about 95% certain that you already have half of a green bar that will automatically jump in and paint. And I could explain to you how the Heikin Ashi bars are calculated. Like the candles are basically, Japanese candle is high, low. Let's just say that this is a dark bar, open and close. Heikin Ashis are calculated differently. They are much smoother. They take averages. So the open of a Heikin Ashi is open and close, open plus close divided by 2. So the Heikin Ashi bar will always open in the middle of the previous bar. And then the close of that bar will be open plus close plus high plus low divided by 4. Again, it's more of an average of what's happening within that within the bar as opposed to just exact movement. I don't really care about noise. I want to know which direction. So the Heikin Ashi bar would already open over here, and immediately, because it calculated this, and immediately it has open, close, high, and so immediately it starts painting whichever direction it wants to go. That's the exit rules. Now, exit rules continue. Now, this is when we're in profit. Any idiot can take profit. But now the most important part of it all is what if we don't have a profit, we have a loss, right? If not in profit, we apply hedging when Heikin Ashi bar changes color on the trend chart, and also dollar cost averaging per minimum trade recovery interval rules when original entry conditions remain intact. What does it mean? That means, remember, we set a rule when you first open a trade, only open 1/5 of it than you normally would. You still have 4/5 or 4 of those segments available for your trade recovery. because the trend is not going to change on a dime on you. The chances are that 9 out of 10 times that you're dealing with a retracement. So when the retracement is done and the trade or the trend is still intact, you may enter back in with the second part of your, with your second fifth of your position, right? But you only do that if you maintain the trade recovery interval rules. And those are very simple. If the average true range or average daily range of an instrument, let's just say a currency in this particular instance, is say 100 points or pips, then you divide that by 5. And that is your minimum trade recovery interval. You will only enter when the entry conditions remain intact, but the price is a minimum of 20 pips away from your original trade. Right? So we'll go and look at it. Now, here's the thing. Most people lose money trading because they get stopped out. They take way too many losses. They get stopped out on both sides. And they quite simply don't know how to get out of a bad trade. They don't really have any bad trade recovery management or experience, right? So what we want to do, we want to create a strategy that no matter how bad our trade is, we always get out with a profit. It doesn't matter how bad our entry is, because sooner or later, we'll have bad entries. And if the market goes against us, what do? See, it is not your ability to manage good trades that makes you a good trader. It is your ability to manage your bad ones. That's what makes you an excellent trader. All right? Now, also, and I get criticized for this by people who just don't have a clue. Well, I made $7 million trading foreign exchange in roughly about 4.5 years. To some people, that might not be a lot. But it's all right to me. You know, to someone who used to be the worst trader in the world. So I think that gives me a little bit of an authority to say I know what I'm talking about. Instead, you have two options. When a trade goes against you, you can take a loss. But now the dilemma is, take a loss with a stop loss. Where do you place your stop loss? From experience, you know that it doesn't matter where you place it, the chances are you'll get stopped out no matter what. If you keep getting stopped out, you'll keep eroding at your account. I prefer not to use stop losses, but when the market goes against me on a trend, which doesn't happen that often, but it does happen, happens more often than I would like to, still, instead of getting stopped out, I open an opposite trade, a hedging trade. In other words, I'm trading short and long at the same time. And I'll show you how. Plus, I use my natural dollar cost averaging. Now here, this is my natural dollar cost averaging with minimum trade recovery interval. All right, let's just say that we got into this trade after this signal over here, right? This was a confirmation. We got in, not a good one, right? Market goes down, and so on. Now, guess what? Over here, we've got another trade. Provided that step number 1 and step number 2 are still intact, we enter with our second fifth. And also provided that there's a difference between these two trades of at least one trade recovery interval, which is 1/5 of the average daily move. Why 1/5? Because you have 5 of those fifths that you can come in on or come in with, but only when step number 1 and step number 2 are still intact. If they are not intact, you don't come in second time. So this is dollar cost averaging with a minimum trade recovery. Guess what happens? The trend prevails. Market goes up. But even then, let me show you something, just pure mathematics. Let's just say that you entered the first trade at 13000, 130. That's your first trade. Market goes against you. Let's just say the market goes against you 100 pips for the lack of, well, not lack of, but for easy calculations. So this is a long trade. Market goes against you, it goes down. You get another opportunity to enter at 1,2900. Now, what is your cost basis on this position? 129.50. So now to make money, the market only needs to go up 50 pips, not 100. So you are in profit as soon as the market reaches 129.51. If you did that 5 times, then basically do your own math. That's why you don't take the full position, because you are always prepared for the worst. Right? So that's how we do it. Rule number 1, original trend is still intact. Rule number 2, minimum trade recovery interval is the difference between 2 trades. That's all the rules. Now, that's one possibility. Again, we're talking about proper trade management, which is really more important than even the entry, because no matter how good the entry, sooner or later, it'll turn into a bad one. Now, hedging, not stop losses, is the key to proper trade management. What do I mean by that? Hedging, trading both long and short at the same time when the original trade goes bad and the market reverses. All right? And I'll show you how that works. We've got the chart of our instrument, which is euro dollar, and this is our trend chart. Notice it's a 60-minute, and it has the trend indicator, which is our 20-period exponential moving average. Now, suppose we got into this trade, our original trade. It was bad. The market reversed. After the market reversed, we have on the trend chart an opposite color Heikin-Ashi bar. That is a signal to enter a hedge trade, which means we automatically go opposite. And we ride that trade until we get a confirmation of the original trade or original trend, until the trend reverses back, which would be over here. So we're taking profits on this trade while this position is still intact. And then we get out at this point when the market reverses again. Because at that point, we are in profit. So as bad as this trade was, look at that. You still got out with a profit. That is how you make money. That is how you succeed in these markets. Now, you could have gotten stopped out, as most people would have. And then you'd be waiting for another opportunity to get stopped out again. Because that's exactly how most people trade. They study the graphs. They're looking at that Ichimoku's and whatever, their clouds and Fibonacci's. And then finally, after 4 hours of analysis, they enter. Trade goes against them. They get stopped out. So, darn. And then they do the same thing over again. That's how most of you trade. Need to be proactive. All right, let's move on. Remember these 5 trade recovery rules. Open an opposite direction. This is only when the trade goes against you. But remember, this will happen only in 20 to 25% of the time, because 75 to 80% of the time you'll be right. Open an opposite direction when the Heikin-Ashi bar on the trend chart signals a move in the opposite direction of your original trade. Reverse or switch positions once the change in the trend is self-evident on the trend chart and the master direction. In other words, if you were long, market reverses, goes short, but doesn't go back long, then what do? You reverse or switch positions. You keep the hedge and you add onto it as a new trade in the opposite direction. Right? Rule number 2, stay 1 net trade plus when the market is going in the direction of your trend. Or that should actually say in the direction of your master direction. And flat when the market is going temporarily against the trend. 3, natural dollar cost averaging will help you improve your cost basis, just like we talked over here. But only in the direction of the original trend in extremely oversold, overbought conditions. Also keep in mind that there's a requirement of the minimal trade recovery interval. 4, keep your worst enemy, your own emotions, in check. Never fall in love with any one trade. Here's how most people trade. They open a trade and then they pray. Then they pray. They just can't force themselves to change directions once they got committed. You're never committed to any trade. Now, the market always does what it wants, not what you want. Even praying doesn't help. Do not listen to anyone, including the so-called experts on CNBC or Bloomberg. Nobody knows the future direction of the market. Nobody. Unless they have a crystal ball. If somebody tells you they know which direction the market will go, they will lie about other things too. You can use statistics in your favor to improve your odds, but that's about it. All right, and remember, nothing matters except the price. And then trading automation, in today's day and age, this is really the key. If you can automate your trades, everything that I did Everything that I do, I don't really do manually. My setups to trade. Software does it for me because it can think a lot faster than I can. It doesn't need to sleep. Can watch the market 24 hours and basically relieves me of 90% of the stuff that I'd be doing if I were trading.